it is a trend, right? We've long talked about ETFs, the passive funds, the cheap things, really challenging active asset managers. Why is the challenge greater now than it has been before?
Well, Dani, as you said, the challenges have been around for at least a decade. The investors have been largely ditching active mutual funds to go to cheaper passive products, and asset managers, active ones, have been trying to deal with it. But what helped these years were the bull markets that were buoying their investments and, as a result, keeping their revenues high. Now we're entering a new world where interest rates are high, there's no more easy money, and geopolitical tensions seem to be here to stay. So these guys have a bit of an issue because there's nothing to buoy their investments if markets stop rising, and there's no new cash going into their funds to offset the very heavy outflows that we're seeing across the industry.
It was interesting. I was just at a JP Morgan briefing for their long-term capital outlook, and they said, look, markets are about to get more difficult. The bull market is over. Therefore, you need active managers. You need hedge funds, kind of pitching for the opposite, saying that because markets are getting worse, that's when we can outperform. Are many managers relying on that, or is there anything more actively they can do to reverse it?
To be fair, this has been the narrative for quite a few years, that people will come back to us and they will need us when markets are more challenging. But if you look at the data, the passive products have been gaining more and more market share, depending on whether markets go up or down. And they are about half of the money managed across active and passive funds in the US right now. 10 years ago, they were 27%. So it seems that people prefer to pay less money than trust the active managers. That, of course, I'm here to be proven wrong, but that has been the narrative for quite a few years, and the trend has not reversed. So while it sounds like, it should or could be the case, the numbers are not necessarily supporting it so far.
And Loukia, I love how you describe this in this story. It's a slow decline into a cliff edge moment. What tips these firms over the cliff edge?
Well, I think there is a general consensus across the industry that an extended bull market will tip many of these companies over the edge, because when your margins are already squeezed, M&A hasn't really worked. New strategies to give you an edge have made you all look more like each other than less. And then you have markets stopping to help your revenue and no new money going in. You can see how many of these guys that don't manage to differentiate or transform themselves might just gradually stop existing.